So let's start off a little bit and give everybody your bio and how you came to Motley Fool, and then specifically how you work your role. That'd be
Yeah.
great.
Yeah. No problem. So, um, I guess I always knew I wanted to be an investor, and that was born from I have an uncle who was, um, always a self-employed piano teacher. So not exactly the most lucrative of career choices. But nevertheless, even though we never lived in the same geography, he was always present. He was always going on vacations with our family and showing up for holidays. And so when I was, in my teenage years, I sort of realized I asked the question, how is this possible? How is this man able to fund, a seemingly comfortable lifestyle? And so my earliest conversations about investing were with him. And from my high school days, we sort of became pen pals where we would read investing books, jot notes in the spine, and send them off to one another, and then talk about them. So I ended up choosing my college because at the time they were one of the few schools who had a student-run investment portfolio, and I wanted to get my hands dirty. So shout out to Stetson University. It's a very common setup now, but at the time it was not a common situation for students actually be able to, in an unencumbered sense, make the investing decisions with a chunk of money in the endowment. So that was, I sort of was on a straight line to investing. It was just a matter of executing the plan. My first jobs out of college, I knew I wanted to go for a small firm again, so I could get real experience and learn. And I ended up getting hired by a small family office in Naples, Florida, husband, wife, and friend trio. Each of them ran their own business. So there was a traditional wealth manager. And I guess in that business, I was just sort of the grunt, helping manage client portfolios. And really that experience helped me put a face with the money being managed, an ultimate respect for, the impact that your decisions are having on, real life people. Second business there was a startup covered call hedge fund. And so I helped do sort of the legwork to get that up off the ground, put some of the systems in place. That was really my first exposure to options. And, that really forces you to think a different way. It forces you to think in probabilities, and realize it helps you realize that there's more than one way to express an investing thesis. And then the third business was the three of them had a very small venture capital startup. And so they were placing investments with mostly local in South Florida businesses. And so I got to do a lot of research on private businesses. And really that taught me, I think, to appreciate the mosaic theory, because there's not public filings that you can go read to learn about these things. You're having to gather information from various sources, and piece it together. So an awesome start for the first couple of years of my career in South Florida. Gave me the confidence to fulfill what was a dream from college to go start a hedge fund. So I met up with a buddy of mine in Boston, and we started a hedge fund in 2007. That was a great experience. That was really poor timing, as it turned out. So, we set up our hedge fund, which at the time was no small feat. Now you can buy a hedge fund in a box and have everything you need for a couple grand. But at the time, that was not the case. It was a lot of hard work just to get things off the ground, raise a little bit of money from friends and family, and give it a go. Teeth of the financial crisis made raising further money challenging. And so happened that while I was in Boston, I met my wife and had to decide whether I wanted to bootstrap a hedge fund or try to secure something a little more stable for my family. So anyway, that experience was a good, I think, risk early in my career to take, managing money through the financial through the financial crisis. Taught me the importance of being flexible, because there were things that were working surprisingly in that environment. Shorting There were a bunch of take privates that were happening for small caps that were dealing with the increased cost of regulation. They were tendering shares, and because we were so small, we could buy up to the limit of the share count and get a cash premium. So there were ways to make money. You just had to be dogged about trying to find them and flexible. So anyway, when I decided to turn back to sort of a more traditional route, there weren't that many firms hiring in 2010, but I was able to work my way into the Motley Fool, the publishing side of the business. And the only way in at that point was through their development program. So even though, I was somewhat established as an investor, I got hired into their training program, which was a year long, which really afforded me a lot of time just to reflect and figure out truly what I believed about investing. And the thing that I learned through that experience in my early days at the Motley Fool was really the power and value of leaning into the qualitative side of investing. Obviously, the Motley Fool is a publishing business that communicates with retail investors. And in order to do that effectively, you have to take this sort of core nuts and bolts fundamental analysis that everyone does that's oftentimes dry and complicated. And you have to wrap it in a way that people can understand. And hanging your hat on some of the qualitative aspects there really helps give you the connective tissue to tell those stories effectively. And so I did that for a couple of years, eventually taking over the training program that I was brought into. And so I got to train up a bunch of great analysts who are now, doing great things, many of them. So that's, proud parent moment. And in 2015, I guess, I got the call for asset management. They were looking to strengthen their team. So I joined the regulated side of our business, which is where I am now. There's a very distinct line between the publishing side and the regulated business, asset management that I'm in. Became director of research and really just sort of got my hands dirty, I'd say, strengthening and solidifying the investing process. And then in 2017 was made CIO when our previous CIO took a role back at the publishing company. So I've been leading the team since 2017. So a pretty straight line investing journey for me, but maybe an uncommon one.
Yeah, I mean, a little bit uncommon, but I like that you mentioned the hedge fund experience. I also managed a hedge fund, and thinking through the short side is so important because it teaches you further about the risks of being on the long side, right?
Yeah, definitely.
And I learned a whole lot on the short side, and often speak to people who are short, frankly, some of the stocks that I'm long, and then you see how it plays out. And a lot of it plays out short-term, mid-term, and long-term. But you guys think very long-term, which is part of your culture, right? And it gives you maybe some flexibility where other folks don't have that. Talk to us a little bit about, how you guys think in the context of long-term and buying, businesses as opposed to just stock movement.
Yeah, absolutely. So that was one of the really great things about connecting with the Motley Fool early in my career, and then having asset management be born out of the Motley Fool, is that long-term ethos, that long-term mentality was firmly in place. And it was in natural alignment with who I am personally and how I am as an investor. So the core belief that hopefully everyone on my team can recite is that independent research with a long-term mindset expressed through focused portfolios can outperform. That is what we hang our hat on. And there's three pieces to that. There's independent research, there's the long-term mindset, and then there's building focused portfolios. So you asked specifically about the long-term mindset, and really that goes back to first principles of, in the long run, we believe that our portfolio returns are going to converge on the business returns that our companies achieve. And, that's determined by the realized earning power and cash flow of the businesses. And then ultimately your holding period. We know that, mathematically, long-term returns, the longer you hold a company, the closer your returns are to the returns of the actual business, and valuation becomes secondary. It's still important, but it becomes secondary the longer you hold. So really that long-term orientation helps ensure that we're thinking a little bit differently than I think the typical investor. And if you look at, average holding periods of mutual funds and ETFs, I think that bears out that even though they're, a more long-term orientation, I feel like has come in vogue a little bit more so than in, decades past. It still is rare. And you especially see that in times of stress. So really that long-term orientation is something that we screen for when we're bringing people onto our team. And it is something that systematically we try to, arrange how we do things to reinforce.
Interesting. Yeah. So speaking of long-term, I think Charlie and this small cap fund is now coming on 5 years, or past 5 years.
October. Yeah.
Congratulations, Charlie and team, for, you can't get around it. It takes 5 years to build a 5-year track record. So TMFS is that ticker, right? So anyway, great conversation there. I'm glad to know you better, having heard all that. It's funny because like me, you came through the change in Rule FD, full disclosure. So it's totally made research different. And part of your role, I think, is, being the maestro of the analysts and the portfolio managers. Speak a little bit further about the level of due diligence and how you all go about portfolio management and the research process to find an edge. Because it just can't be, I own, great businesses, forever.
Yeah. It's interesting with, I remember in my earliest days, I absolutely was still requesting physical annual reports from companies and waiting for them to show up in the mail. And so you've seen that change, as well as just the variety and quantum of information that is now available. Honestly, I feel like one of the greatest skills an investor needs to develop is that of proper filtering. And that's actually a really nice segue into our game selection. Our primary filter for looking at business is quality. And I should have thrown up air quotes there because, everyone, quality means everything and nothing all at the same time. And that's actually quite how we like it. So you've probably heard in past conversations with Charlie and Tony, we view quality not as a single thing. It's sort of the set of attributes and their interplay that can explain why a business might be special, forecastable, or can achieve, uncommonly great results. But it's also, for us, that important filter. It's the way we analyze a business that we think stacks the odds in our favor of limiting capital loss and boosting the odds for really strong outcomes. It narrows our focus towards businesses that we think are special and have special attributes. And so we look across 4 pillars: management, culture, and incentives, the economics of the business, the competitive advantage, and then trajectory, which is sort of our 10-year forward look at why the business will still be relevant, will be more relevant, more valuable, and sort of how value capture changes across that time. So with all of the available information that's out there, we have determined that the most important thing for us to know and identify are companies that meet our quality threshold and those that don't. And if all that we do is get that right, I think our investing return should be fine. Now we want to do better than fine, right? And so there's other layers to that. But if all we do is get that mostly right, I think we're probably going to be okay.
It as a result, you have very high active share in your actively managed strategies, particularly. Talk to us a little bit further about how you view active versus passive, because you guys have both, right? I mean, does it create a little rivalry amongst the group?
So we are 100% firmly believers that truly active management done well can lead to great results, can outperform. And that's sort of that's what you pay the money for in active management. That's why, we are in this, in this endeavor. That's what we strive to deliver. So I'm fully in support of active management and believe that it can be done. I'm fully aware also of the literature, right? And all the academic work that's done. And there's academic work that supports both sides of the argument. So it leaves us in a nice place. But I think really passive can be good and can be bad. There's no absolutes here. The great things about passive, unquestionably, are that it has dramatically lowered expenses that investors have to pay. And there are few things in investing that are truly black and white. Very few. One of them, I think, is that lower fees are better for the investor. So the fact that what passive has brought to the industry in terms of shining a light on fees and the importance of low fees and being efficient is something that active managers must embrace, clearly. The other thing that passive brings, and that I think is unquestionably good, is a disciplined implementation of something, right? You know what you're going to get with passive. And even as active managers that are dealing in squish, 98% of the time, which we are, we need to be setting up our operations to be as systematic, as reliable, and as repeatable as we can, asymptotically approaching sort of what a passive implementation is able to achieve. Now, you mentioned sort of we have both active and passive, and that's true, but our definition of passive is a little unique. Our definition of passive, well, not our definition of passive, our use of passive is, we call it the passive implementation of active stock selection. And so you notice the jester cap over my shoulder. Our sister company, the Motley Fool, has been around for 30 years, has a fantastic reputation, and thousands and thousands and thousands of, probably millions of fans and followers. But historically, the only way that those retail investors have been able to access the recommendations coming out of our sister company is to become a newsletter subscriber, follow along, read a lot, make their own decisions, go into their brokerage account and click their buttons. What we have done is we have been able to package the IP into a series of ETFs based on indexes that were created by our sister company, and make that IP, those stock recommendations available with the click of a button. So you don't have to become a newsletter subscriber to access it. Advisors can also do this, and it's a great conversation piece for them and their clients who know and love the Motley Fool. So the underlying indexes, though, that our ETFs are based on, that we call passive, are all constructed of stock recommendations by the humans that work at the Motley Fool. So there's that active element of what goes into the universe, and then the construction of the index and the implementation of it is traditional passive implementation. And so it's rules based, rebalanced quarterly, so you get sort of the best of both worlds there, in my opinion.
Yeah, and to your point, I guess it's TMFC, the Motley 100. What a banner year! Congratulations on that as well. So let's talk mid caps now, because we've talked global with Tony, and we've talked small, and I want to put your traditional CIO hat on,
okay,
and talk mid caps. There were some changes on the mid cap portfolio strategy at the top, at the PM side. Walk us through how that came about, and how just give us some context.
Yeah, no problem. So one of the very interesting dynamics of Motley Fool Asset Management being a sister company of the Motley Fool is that we are part of a larger organization, right? The Motley Fool sort of parent entity. And we want both businesses, our asset management business on the regulated side and the publishing business, to thrive. And we are all part of this. We're going after the same purpose, where we are a mission-driven organization. It really does drive what we do. And so while it's very common in the industry to look at manager turnover and view it immediately as a bad thing, right? That's not necessarily the case with us. I mentioned that I became CIO in 2017. I became CIO because our old CIO left. He didn't leave the company, right? He left Motley Fool Asset Management to take a role in the publishing side, pursuing the same purpose, just a slightly different role. That's weird to external people. I understand that, but it's not weird in our little pocket of the universe here. Bill Barker was a named portfolio manager on midcap since the inception, when we were a mutual fund before we converted to an ETF. So I think it was born in 2010, if memory calls. So a long tenured PM with great amount of institutional knowledge. He didn't leave the company. He left to return to the publishing business where his roots were. He's worked for the company for, I want to say, 23 years. He was a founding member of Motley Fool Asset Management and was called to do something else. And, so I'd like to think that he loved his job here and that he didn't leave because of me or anything like that. But that call was there, that opportunity was there, and he took it. It highlights a couple of things to me. One, it highlights the need to have a system that shines and not just people that shine, right? If you just have star PMs, I think you run a fragile system, because something bad could happen. You could have a health incident. Someone else could come along with a bigger, offer and lure them away. And then, your fund is screwed. That's not the way that I have tried to build the system of how we do things, right? I am very interested in running a team here where, the parts are greater than, or the sum is greater than any individual. You'll also notice that every portfolio has multiple portfolio managers. This is also an uncommon construct in the industry, right? It's sort of frowned upon. People don't understand how one can, how you can make good decisions if you have, multiple cooks in the kitchen. I don't view it like that at all. I view it as valuable redundancy. We are real human beings. I'm sorry, I'm on a soapbox here. We are real human beings who have lives that extend beyond work. This is a reality, and I hope people can understand that. People need to go on vacation. You know, people need time off to rest and recover, to do their best work and to do their best thinking. In order to create the space to do that without jeopardizing the day-to-day management of the fund, you need multiple capable people. And so we have a multi-PM structure, and we're often asked if it's harder to make decisions or who has the ultimate say. These actually aren't really hard things to solve for. When everyone is bought into the idea of we're going to own a quality businesses that meet a threshold, everyone is looking for the same thing. And so if we're arguing about something, it's a matter of degree, right? It's how much of something we should own. It's about whether we're viewing the future prospects of something accurately, or we're, amply considering the risks and weighing them. So long answer to your question about turnover, but I was a named PM on midcap. And so when Bill, took the call to go back to his roots on the publishing side of the business, I was still here, and it was very easy for me to then tap another portfolio manager on the shoulder and say, I need you to step up into this role, know these companies a little bit better, and, be a sounding board, for me as we move forward.
Interesting. Yeah. So you said something that sometimes people are uncomfortable about, the argument, discussion. What's the term that your firm that you guys?
Affectionate hostility.
Affectionate hostility. I love that. We have that going too at Title. Okay, so let's talk TMFM.
Yeah, sure.
Usually I start off with the top holdings. I'm going to start off with the holdings that are near and dear to our ETF audience. MSCI and Morningstar. Those are two holdings of that you guys own.
Yeah.
How do they fit with Motley Fool's philosophy?
Sure. So I mentioned our first filter is of quality. And so we analyze every business by looking at management culture and incentives, the economics of the business, competitive advantage, and then the trajectory of the business. I think the people, if anyone is listening or watching right now, they probably understand that, generally speaking, data providers and index providers and software providers operate pretty good businesses, right? They basically are either scaled to they get their revenue from assets, or for recurring contract, highly contracted revenue base. And given that we all probably interact with one of those companies in a fairly regular basis, we also see that they raise prices on us from time to time, and we can't do anything about it because it's a pain in the butt to switch. We get a lot of value actually from what the businesses deliver, and it's embedded into our workflows. And so it's very easy just to off the cuff say, okay, these are probably high quality businesses that meet our threshold. There are some interesting aspects to each, I think, when you're looking at management culture and incentives. And then there's some really interesting aspects when you think about sort of, okay, what, where do we go for the next 10 years, and why will these businesses remain in their prime position or make it even better? So step one is identifying quality. And I think that's a simple argument to make here. We're not going to have a lot of argument about that. But there's more to sort of the buy decision than identifying quality. We want what we have found historically is opportunities come to us in sort of three flavors, and we call them mispricing patterns. And so one mispricing pattern is we call unloved quality. The second is underappreciated quality. And the third is unproven quality. The differences there are in, where we should focus our attention when we're developing our thesis and how we manage the position. So unloved quality is it's where I think the market and the world fully understands that you've got a good business, but something is going wrong at the moment that allows it to go, the company to go out of favor, the stock to go out of favor, and the price fall to something that is attractive to you. That's the case with what happened earlier, this couple months ago with MSCI and Morningstar. It seemed as though someone flipped a switch on ESG, and ESG became political fodder and hated. And anything that existed in the ESG ecosystem was sold off hard. Morningstar has a few other unique sort of aspects that sort of were like kerosene to its sell-off, because its biggest business is actually PitchBook, which provides data to the venture world and private asset world, which has also come under some pressure. So these are businesses that we've known for a long time, that we've studied, but didn't own because we didn't have the opportunity to. And it wasn't until the market started hating ESG, doubting the future growth prospects of MSCI and Morningstar, where these businesses, the price came to a point where we thought the risk reward was attractive. So A, they met our quality threshold, and B, the market served up the opportunity to us. We didn't feel like we had to make outlandish predictions about the future to do well. We thought market sentiment has to turn, and they need to resume a little bit of the growth profile that they have been able to achieve for a long time. And simply by taking a longer term view, not getting caught up on ESG being unpopular at the moment, I think that is what allowed us to establish those positions.
But wait, so the market, the stock, the company came to you basically with price, right, being the appealing part, one part of the appealing part. How do you work through the sell discipline generally? Not so much with those companies specifically, but I'm going to come to Axon Enterprises next, which is an overweighted position, arguably at 7%. I'm not looking to know exactly what you're going to do with that name, but what's your sell discipline?
Yeah. Really, selling is an exercise in managing risk and competition for capital. If you look at the three active funds, I mentioned part of our core belief is that we run focused portfolios. And so we own between 30 or 40 securities at any given point in time. And with mid-cap here, I think we're sitting at 30, maybe 31. So we're on the low end. And really, we want a high bar for inclusion into the portfolio. Selling comes for a couple of reasons. The most common reason, unfortunately, is that we're wrong on quality or thesis. And the way that we ensure that we're able to identify that is we write things down. Every company that we analyze and buy, we have to have two memos written. One is a quality memo and one is a thesis memo. And they're two separate documents because we're answering two separate questions. The quality memo is answering the question, does this company meet the threshold of quality that we should be able to buy it or not? The thesis document addresses, should we own this now and why? Other things that we talk about in the thesis document is we have a section called, Are We on Track? And here we're trying to highlight the 3 or so things that matter most to our thesis playing out. And ultimately, if our thesis plays out, we think, we'll get the returns that we're shooting for. So every quarter when we get, new information from quarterly reports and the call, we already know the areas we want to focus on. We don't care what the company wants to talk about. We know the 3 things that matter to our thesis playing out. Now, we can be wrong on quality and we can be wrong on the things we're focusing on. So the important part for us is that we've written it down so that we can hold each other accountable to checking back in on that in a timely manner. And given that we only have 30 companies in the portfolio, we don't have a lot of room to be thinking about things wrong. And we have to be honest with ourselves that if we identify that we are thinking about something wrong, we need to move on. So that's first and foremost for selling. Secondly is when we have demonstrably better opportunities. And so you'll see this with, moving capital within the portfolio. But in some cases, it's sort of like 1 in, 1 out. We don't have to manage the 30 to 40 portfolios, but we believe, or 30 to 40 holdings, but we believe it's sort of gives us the best shot at achieving our goals. And so we often will, to maintain, proper diversification, how we view it. We don't want to own 4 companies selling to the same customer group, but we will own 2. But adding a 3rd one is very unlikely. And so we would probably do a replacement. A good example of how we approach that was, we have been longtime investors in the HR payroll software businesses. And we owned a company called Ultimate Software, as well as Paycom, which is still in the portfolio. Ultimate Software was bought out and created room for us to add Paylocity. It was a business that we knew well, but there was no way we were going to own 3. So better opportunities, and that sort of opportunity cost trade-off is another thing that causes selling.
Do you find that a lot of your companies are asset light? Because it sounds to me like what you've described are companies that are asset light.
No. Yes, probably if you did the split, more asset light than not. And, pillar 2 is economics of the business. And so that is where we analyze everything that goes into that decision. But we have a great appreciation for, the value of hard assets and irreplaceable assets. I know you spoke a lot to Tony about companies like Waste Connections and Canadian National. So these are, physical asset businesses that just have irreplaceable physical assets. So I don't think that we necessarily default to one or the other. We have an appreciation for where both can matter. I think what we find is as you go further down the market cap spectrum, asset light and intangible assets become more important because physical assets, you need capital to compete with, right? And so if you're a smaller business serving a smaller end market, you probably need a smaller amount of capital to recreate the physical assets of a business. And so that seems a riskier proposition to me. If you're reliant on, some physical assets, but you're serving very small, they don't cost a lot to reproduce. That seems to be a risky place to be. I do think one thing you see if you look at our businesses is we do like where software can complement some sort of hardware because it makes things stickier. So that's a theme I think that you see in some of our portfolio holdings.
Where does Broadridge stand in that context?
Yeah. Well, Broadridge is highly sticky.
Dependent on Broadridge once you have it.
Yeah, absolutely. So Broadridge is a company that I've followed since it was spun out of, I think, First Data in like 2010, maybe. Yeah. And its crown jewel asset is its position in between issuers, corporate issuers, financial institutions, and investors. It essentially runs the proxy system for the U.S. and increasingly much of the world. And I'll stop short of calling it a monopoly, but they have a very dominant position. And they are very engaged with regulators. It's a regulated business that they operate in. The price that they can charge is set by regulatory agencies. So it's not a business that comes with immense pricing power, but it is such a dominant position, and they manage that business so well that it has created a cash cow engine for them to deploy smartly elsewhere. And because they have this centralized position with all of these existing customer relationships, they already have the ear and the credit card numbers of firms to keep selling them more services to grow their business at a very reasonable pace over time. And I think one of the truths you have to believe to be a Broadridge shareholder, which we very much do, is that companies are best. Companies are spend their time wisest when they engage in value creating activities and allow non-core sort of typical like cost center activities to be outsourced and mutualized. And that's what Broadridge does, is they mutualize non-core costs, typically tech-heavy tasks, computational heavy tasks, regulatorily, monitored tasks. They need to be done right. They cannot be done wrong, but they provide very little actual value to growing your business. And so they have just done a magnificent job of doing more and more for the financial industry, allowing the financial industry to spend its time elsewhere. And that's another theme I think you see in some of our portfolio companies is companies that are willing to do that slog work and get paid a reasonable fee for it, to allow companies to do what they do best, where they're differentiated. We have a small holding called Goosehead, Goosehead Holdings. And that's essentially an outsourced back office for insurance salesmen. I mean, every advisor that's on this call understands that their differentiation, their money, their value is in the conversations they're having with their clients, the relationships that they're building, maintaining. It's not in doing the paperwork. It's not in making sure that record retention is everything that it needs to be. And so we love businesses that can carve out really strong positions in supporting growing industries by just taking on some of that slog work.
Yeah, you call it slog work, but it requires them in many cases to reinvest in their business, right? I mean, how focused are you in your analysis and your team's analysis on how companies invest back in their business to grow?
Yeah. The fourth pillar of quality is trajectory. And in that, we're trying to answer the question, why will this business exist in 10 years? Why will it maintain its position or strengthen its position? And to answer that question, we have to understand the size of the market that it's operating in. So what is the runway? We have to understand how competitors are behaving, right? Because no company exists in a vacuum. Competitive response is a real thing. And we have to understand the investments the company is making to protect its competitive advantage, extend its competitive advantage, grow it into new areas. And so we're very concerned about where investments are being made, how they're being made. And so for a company like Broadridge, what we like to see and understand is how they're deploying their capital. And Broadridge is in the great position where it generates more capital than it needs to run its business. And so they have a healthy dividend policy. They historically have been able to repurchase shares. But they also have made, and outside of 2 large recent acquisitions, they have a very healthy program of bolt-on acquisitions where they're able to take small products, small data sets, small features, oftentimes, roll them into their sales engine, improve the value of their products, be able to, grow sales and ensure that when it comes time to raise prices, they can turn back and say, look at the incremental value we've delivered in this product for you. So we see them making those bolt-on acquisitions to improve their offerings. But we also saw them over the last couple of years invest heavily in building out a wealth management platform. And they signed on UBS to be their first customer, and they worked hand in hand with UBS for years to develop a soup to nuts platform for UBS to run its wealth management business off of. This was a multi-year project that crushed free cash flow generation, but was, we believe, to be the right long-term choice. They had to suspend share buybacks for a little while. You saw free cash flow conversion go into the can for a couple of years, but we believed it was the right long-term investment to make, that ultimately the payoff would be there. And we're starting to see that. We're starting to see sales ramp there. They've announced a few more customers. They've modularized things so that they can sell small pieces instead of a whole rip and replace platform. And we've already seen free cash flow conversion come back to more historical levels. So we think what that has done is it has now taken the, slow and steady growth that we could foresee for the next 3 to 5 years, and it's extended that to now 5 to 7 years. We feel pretty confident that Broadridge should be able to deliver reasonable growth in our eyes anyway.
Yeah. Ryan, this has been great. I'm glad to have caught up with you. Believe it or not, basically the hour is gone by already.
It's flown.
Yeah, it's flown, and people can find out more at your website, Motley Fool Asset Management, or just Google Motley Fool ETFs and find out a lot about what you guys own. Thanks very much. I hope you weren't offended by my cap.
No, I love it.
Or my gloves. I have a great holiday, and thank you all for a wonderful year in 2023. I look forward to 2024 and sharing more episodes and conversations with y'all. Thanks, Bryan.
Yeah, thank you, Dan.
You're well. Bye.